In theory, any acquisition must pass the test of being the best strategy for enhancing shareholder value. But, in the real world, we need to keep in mind that the goals and motivations of the individuals running a company play a large part in the decision to make acquisitions. In simple terms, we also need to consider how an acquisition will affect the careers and financial stakes of the key decision makers. Synergies is a notion that two or more businesses in combination will create greater value than if they are operated separately. Where 1 + 1 is greater than 2. There are three basic types of synergies. Operating synergies is achieved through the improvement of operating activities, such as reduced costs from economies of scale or even increased sales by cross-selling of products to the customers of the acquirer and target. Financial synergy arises from the improved efficiency of financing activities and is primarily linked to a reduction in the cost of capital. Tax synergies arise when acquirer is able to use target's underutilized tax benefits such as loss carry forward and investment tax credit. Acquirer utilize the tax benefits by offsetting against the acquirer's existing taxable income. I will cover in detail synergies and the modeling of synergies in another video. So stay tuned. Diversification is also one of the strategic rationales behind an M&A transaction. Buying firms outside a company's current primary lines of business is called diversification, and is typically justified in one of two ways of expanding the sale of a current product from its current slower growth market to a new market, which might be unfamiliar of risky, or acquiring new product which a firm is unfamiliar with to achieve higher growth. There is considerable evidence that investors do not benefit from unrelated diversification. Firms that operate in a number of largely unrelated industries, such as General Electric, are called conglomerates. An M&A might also occur to increase a company's supply chain pricing power. A vertical merger is the merger of two or more companies that provide different supply chain functions for a common good or service. Most often, the merger gains more control of the supply chain process and ramp up business. A vertical merger often results in reduced costs and increased productivity and efficiency. Vertical mergers reduce competition and can provide the new single entity with a larger share of the market, which indirectly allows the company to increase its pricing power. Many M&A deals are also done to eliminate competition. If you are the number 2 or 3 in the market and you acquire a player of a similar size, your power in the market will increase. To eliminate a direct competitor is quite often a reason for an acquisition. This can be the case on a national but also on a regional level. A premium is often required to convince the target company, as they will also know that their strategic position will be of a large benefit for the buyer. You may acquire a company simply to prevent a competitor from owning it, so that you can protect your current and future market position. Bootstrapping. Bootstrap effect or bootstrap earnings effect refers to the short-term boost in the earnings per share of the acquirer company when it merges with the target company, even though there is no economic benefit from such combination. Let me explain how this works. This happens when the acquirer, who is trading at a higher price to earnings, calculated as share price divided by earnings per share, acquires Target Co., which trades at a lower price to earnings ratio using a share swap deal. This means acquirer will have to pay for the market value of the shares of Target using its own shares. If acquirer acquires Target through stocks, there will be fewer combined shares outstanding post-merger, since earnings remain the same but there are fewer shares of stock. The earnings per share ratio increases favorably. Investors may not understand the reason behind the increase in earnings per share. Instead of getting to know the underlying reason behind the sudden surge, investors may believe the earnings per share increased because of the synergy created through the merger, resulting in the increase in the value of the post-merger stock. Companies may enjoy this temporary boost in stock price, but the bootstrap effect generally becomes apparent in some years. In order to sustain the earnings per share ratio at an artificially surged level, the company would have to continue to play the merge and expand strategy by aggressively acquiring companies at the same rate. Once a merger and expansion spree comes to a halt, the earnings per share will decrease and the stock price will follow suit. Let's walk through an example here. Looking at the first 3 rows of data, we can see the market value and share price of both buyer and target. Market value of equity is basically derived by multiplying a company's number of outstanding shares with its share price. In the next 3 rows of data, we have the profits and EPS of both buyer and target. Again, earnings per share is basically calculated by just taking net profit divided by a company's number of outstanding shares. Once we have the share price and earnings per share, we can now calculate the price to earnings ratios of buyer and target by taking the share price and divide that with the EPS. As you can see, the buyer P/E ratio is much higher than the target's P/E. Simplistically, Let's assume an acquisition scenario where the buyer acquires the seller at its market value of $3 million. And no premium to the market value has been paid. And let's just assume that the acquirer uses its $100 priced shares to pay for the $3 million acquisition. How many shares would acquirer need to issue? The maths is simple. At $100 per acquirer shares. To pay for the $3 million in target's share. We divide $3 million with $100 per share to find out the number of shares the acquirer need to issue. Which is 30,000 shares. So, as a result of the merger, acquirer's shares will increase from existing 100,000 shares to a total of 130,000 shares. Including 100,000 old shares and 30,000 new shares. But remember, the acquirer earnings will increase by a larger quantum than the shares increase. As the acquirer will get a 100% of the target earnings. Hence, the post-merger earnings of the merged entity will be $850,000. Which is 600,000 profits of the acquirer plus the 250,000 profits of target. Now, all we need to do is to calculate the post-acquisition EPS of the acquirer. We take the post-merger earnings of $850,000 and divide that with the acquirer's new share base of 130,000. Which is $6.53. It can clearly be seen that the post-merger earnings per share of the acquirer is greater than the acquirer's earning per share before merger. Which is mainly due to the effect of increase in total number of shares of the post-merger entity. That is not proportionate to the increase in acquirer's post-merger earnings. Again, investors may not understand the reason behind the increase in earnings per share allowing the company to enjoy temporary boost in share price. But this will generally become apparent in some years. So this should not be the only reason which drive any big strategic acquisition decisions.